Thank you very much. I definitely think Mark's the star. I'm the warm-up act, ladies and gentlemen. And I have some simple things really to say to you today. I just wanted, first of all, to remind you why people save, because you'll have learned savings equals investments. Tell you that an important way of investing money so that you can hang on to your spending power is through equities in companies. Equity investing comes with it traditionally a responsibility to govern the companies. That's how our system works. And in this kind of investing is increasingly done through large institutions. I wanted also to talk about some of the problems we have. Large institutions may not actually be inclined to get too involved in governing the companies in which they've made their investments, and even the boards of some of these public companies may be somewhat disengaged. And where does this get me? It gets me to the need for longer-term investors who will engage with companies and boards that will be more engaged for the long term in those companies. And that's the lead-in to what Mark does. The Canadian Pension Plan Investment Board, CPPIB, is a long-term investor. And as you'll hear from Mark, not only is it providing the returns that Canadians need, it's taking that money from Canadian savers and investing it effectively so that they can, at the very least, hang on to that buying power into the future. But it's also, on the other hand, investing in companies and overseeing those companies well. And more of this long-term investing, I think, will be required in the future. So in a way, that's why I'm delighted to be the warm-up act, to be the introductory act to what Mark is going to say. Now, I now need to find my little pointer. Here it is. Let's see. So very quickly, savings and investments, institutionalization of savings, controversies today, how public markets work, emerging solutions, and Mark's part of it. Okay? Now, I'm not going to dwell on these slides for too long. I'll just touch on a few. Here we go. Why do people save? It's usually for the future. They anticipate a future when they won't be earning as much as they do today. They save for it. And indeed, in China, you do that and to a great extent. When you're a bit younger and have responsibilities, the form of saving you do is called insurance. You know, when I was in my 30s and 40s, I had a big insurance policy to protect my family. Later, you accumulate money. So savings build up, and then you go off and play golf at the end and spend it all. So that's the typical life cycle. What do you want to do with this money? Well, at the very least, you say to yourself, I want to have, post-inflation, the same amount at the end. Well, you know, if you look over the very long term in the States, you would have had to earn 4% per annum just to keep up with inflation. But keeping up with inflation is a rather low target. Wouldn't you like to have the same spending power in the future with that money as you have today? And there's a bit more to that than inflation because the economy grows every year, and more importantly, GDP per head grows every year. So let's give ourselves a bit of a more aggressive target. We're going to keep up with the Joneses, as the slide shows. If we wanted to, over the very long term, and these are, again, American numbers just because they're available, if we wanted over the long term to make sure that our savings pot kept up with GDP per head plus inflation, that'd be a nice way, perhaps, of saying to ourselves, we've hung on at the very least to that spending power. You know, we've got the same amount relative to everybody else in the future as we had in the past. Well, over the very long term in the States, you'd have fixed yourself a target of 6.1% to achieve that, hanging on to the spending power. And what could do it for you? Well, I wouldn't go into bonds. Bonds can get you about 2.4%. as against the 6.1 that we've just set ourselves as the target. Real estate, by the way, the numbers don't go back to 1880, but Schiller has gone back to 1900, and he shows that real estate would get you about 6.1%, not far off. This is homes, American homes, so one part of real estate. But the real winner, the thing you've got to be in, are equities. You can see that, 6.8%, beating that 6.1 by a little bit of distance. So it won't surprise you to see that American households, their savings are in that dark blue. There's a lot of it in equities. That's what the bottom dark blue means. Forgetting, of course, that they do have an investment in their homes, which they live in. So here's the numbers with people's real estate in it, with primarily their homes. 38% in their homes, and then the biggest next chunk in equities. The two categories of long-term investing that give you a pretty good chance of still having the same spending power in the future as you had when you put the money away. Make sense? Okay. So where does it go? Well, equities, where does that money end up? It goes into companies. Why do companies need the money? Companies need risk capital, which is what equity is, mainly for growth. Not just for growth, but mainly for growth. You'd have seen that sometimes when things go wrong, they need to replenish their risk capital. Anybody who's watched the banking industry in the Western world will have seen that in recent years. But in the main, companies come to people who are savers looking for new money when they're growing, and they need that capital to fund their growth. They can't do it all from debt because the income from the new business hasn't started to come in, and it might not. It's risky. So equity is the way to do it. And this is just the life cycle, briefly, of a company from its early days of venture capital to growth capital and so on. Equity owners bear the ultimate risk. You know this, probably from your studies. They're the ones who get paid last. And in return for this, they get to appoint the board of directors, and they can vote on resolutions. So they are, at the annual general meeting, they are in charge of corporate governance. And in a way, the hope when the corporations were first set up was that they would deeply engage in this business of overseeing companies and making sure they were going in the right direction. Because after all, they were the ones to whom the profits would accrue. Okay? What's happened? Well, one of the things that's happened is, again, I've used American data. American households don't invest directly so much in stocks. They increasingly invest through large institutions. And you can see there's a crossover point there about 1995 where more money that was invested in equities went through a large institution than was invested directly by Mr. and Mrs. Joe Blogg's investors. And these large institutions are companies like this, pension funds, CPPIB being a very interesting example of a large pension fund, mutual funds, and insurance companies. And you can see if you add them up here, there's about 80-odd trillion, I think I'm right in saying, of money which ultimately comes from households that's invested through these institutions. So the individuals aren't buying shares, they're going through these large institutions, who, by the way, as a result of this, if you're good at adding up quickly, own about 50% of the equity listed on stock exchanges. So the money comes from the households, invested for the long term, but goes through increasingly these large institutions. Sounds good, doesn't it? Good system. People save. Money goes into companies. They need the money. And in return, those who own the shares get to govern the companies, appoint the board of directors, set the rules, in a sense, within the law. What are the difficulties? Well, one thing that happens is large institutions tend to get measured against the index every year. So there's a bit of a temptation, if you're measured against the index every year, to sort of invest in the index or pretty close. And when you're that widespread, when you've got lots of different shares, it's quite hard to find the time, effort, and analysis required to oversee the companies and come to a view as to whether the board of directors is doing the right things. In other words, it's quite expensive to do governance if you've got shares in thousands and thousands of companies. And here's just a chart showing that even though in theory a well-diversified portfolio probably only needs about 30 stocks, many of these large institutions, for a variety of reasons, end up investing very broadly. And in fact, many of them, very few of them, invest as what's called intrinsic investors, come to a view on this company and its future and invest in a focused manner in that company. A large chunk is overt index investing, and then you can see another 26% is closet index investing. These are companies who will invest on your behalf, and they say they're managing the money, but actually when you look at what they're doing, they're pretty close to the index, and that's why they're called closet index. They're sort of hidden away. So only a small number actually doing what you would hope, which is to look in detail at a company, come to a view as to its prospects, maybe even influence it through the board of directors and try and make the company better. And this pressure of the index can also work its way down to boards. So imagine if you're an investor and you're just slightly off the index. You know you're judged against the index every year, and suddenly the company may not hit its earnings target and the price will go down. You're going to look bad. Maybe you won't have a further mandate for that money from the people investing through you. They put big pressure on boards to hit the earnings target the board has set for itself. And this can make them quite short-termist. And this is an illustration of what can go wrong. Managers will tell you in large corporations that they'll forego economically positive opportunities to invest if it's going to cause them to miss earnings targets in the next quarter. They shouldn't do it, really. Economic theory says they should take that opportunity and explain to the investors. But remember, these are jittery investors who've got hundreds of different stocks, may not have time to listen to the explanations, and may frankly be worried that they're going to lose their mandate if this company doesn't hit its earnings targets and keep its share price up. Okay? So there is this difficulty of short-termism that comes about when institutions feel they're being measured against an index and perhaps don't have the courage or wherewithal to stand up to that pressure in the long-term interests of the companies involved. The other people who could resist this tendency towards short-termism might be the boards of directors of the companies. They might say to the investors, well, look, we're not going to hit the earnings targets, but we believe it's in the long-term interest of the company. We're doing it anyway. You'll just have to live with it. And some do. But what we found when we looked at it is the boards of directors of public companies are somewhat less engaged than those of private companies. So there's a bit of a deficit in our system there, too, where these boards of directors of large public companies, when you ask them themselves, they give themselves an overall assessment of effectiveness of about 4.5 when they're private equity-owned companies, and 3.5 for public listed companies, to give you this example. And why? Well, in general, they're just less engaged. They're more focused on compliance in the public company and more focused on value creation when they're sitting on private company boards. So 2 challenges to the system I would propose to you. One is that large institutions may cause short-termism if they themselves are very focused on their short-term and hanging on to their mandates, their investment mandates. And furthermore, the boards of public companies may not be sufficiently engaged to push back against this short-termism. They need to spend time, they need to understand the company to be able to resist the pressures from some of the more short-term investors. So what are the solutions? 2 sources of solution that we think are important is firstly to get those large institutions that have long-term money to start behaving in a very long-term way, so they send that signal to managers who might manage the money for them further down the line, and to boards further down the line who are making decisions about their investments in their companies. And by the way, to get that going, these large institutions should make sure they incentivize their own people on the long term, not against a shorter term index. It's quite hard if I work, it's quite plausible that if I work for a long-term pension fund and I'm assessed every year against the index, I take a 1-year view. And long-term money I'm managing suddenly is being managed by me in a relatively short-term manner. So getting the right signal from those long-term institutions, and Mark will talk to you about this some more, I'm sure, getting that signal to go right down the system all the way to the boards of companies so that they behave in the right way, that they make investments that are valuable for investors rather than simply hitting the next quarter's earning target, we think is one part of the solution. And the other part of the solution is greater engagement on the parts of boards of directors, especially the non-executive directors. So they too are setting strategies that create value and understand them intimately enough and have spent enough time on them so that they can defend them against short-term investors who might have them suboptimize.